Here we're just going to pick up where we left off with the last slide, because I think this is the important one when you look at the low wage industries, middle wage industries, high wage industries, and you're seeing how the pressure remains on that high wage side, because those are the individuals that have the most disposable income, the most to spend in general, and you're seeing that pressure come in where middle wage is getting better, but again, not back to where they were, as low wage continues up, but they're not keeping pace with inflation, which is why real wage growth still remains negative. And with inflation now accelerating again, moving up in another way, that becomes a much bigger problem as we look at, well, how are we going to maintain spending? And as we mentioned earlier, 1 in 4 individuals talked about how people are pushing back on price now. So you're starting to see more and more pushback of, no, I can't do that price. And you're seeing that as input prices, output prices continue to go up because they're trying to pass on as much cost as possible. And there is a breaking point, and I think we're getting close to that. But when we look at Americans' Christmas spending plans for the October estimate, you get an idea that obviously it's going to be better than 2020. Now, remember, we had a different number last week, and that number was higher than what was expected so far. So this is a bit of a different trend, but you're getting an idea in terms of where things are sitting right now of average spending estimates in dollars. So here's where, about $837, roughly how much money do you think you personally will spend on Christmas gifts this year? So you're starting to see a little bit of a pullback, but on family, it's going up. So you're seeing some, I think, balancing act as to who are you spending money on, and especially as inflation goes up. So then U.S. personal consumption expenditures, durable goods, and this is that chain to $2022. So we had an 80% move annually adjusted off the low, and now we've come back 22%. We're still elevated. It's not a bad thing. It's just, where is that trend? And the trend is going to continue to come down. Real good spending is cooling from its peak, very strong 80% annualized gain from pandemic low to March 2021 peak. Since March, spending has fallen at 22% annualized rate, and we expect to see that continue to come down as we get additional pressure coming into the market as people pivot away from goods and more into services. And that's when you start looking at that personal income. So this is what we've been talking about with how this spending is and where wages are, because personal income came down by 1%. And the Bureau of Labor Statistics, the cost of working exploded up 1.3%. Personal consumption, and this is chained to 2012, which is why it's important to think about that, was up 0.3. So that means that even with the amount of inflation, they're still spending. They're still there. And then personal expenditure chain priced was at 4.4%. So you're still getting that inflation. And then U.S. personal consumption expenditure core price was still at 3.64%. So you're still getting that inflation. You're still there on the inflationary side, but people are still spending. Slower, they're slowing, but they're still spending. But personal income, so you have personal income falling, and you have wages not keeping pace, and that income's going to keep getting worse because, again, a lot of that is driven by government transfers. So then when you look at CITI inflation surprise index continuing, starting to get a little bit normal, better, because the estimates are going up, and you're starting to see these estimates get a little crazy, as obviously we're going to maintain our current spending patterns. And then when you look at the surprise index, it's still negative, but getting better. Again, estimates are starting to catch up with where things are and what that future looks like. But where we go from here. So the U.S. CPI primary and owner's equivalent rent just starting to crest, and the apartment rent for recent movers from apartment list, which leads by 5 months, is parabolic. And just look at where the trend is, and we just expect, again, CPI and owner's equivalent rent to be the leading driver of that CPI pressure to the upside. And then what are some of the contributions? So motor vehicles actually had a negative contribution to it this time around. And based on what the numbers are right now, it's going to have a positive contribution. When you look at food and energy, that's not getting any better, especially based on food, as we talked about in segment 1. Housing is going to become a much bigger and bigger and bigger part of this based on the chart from before. And then the core X motor vehicle is like that core piece is just expanding based on what we know prices are going to be by year end. And that's when you start, we have to understand what is this personal income dynamics that actually went negative. And despite steadily rising labor compensation, personal income growth fell 1% in September as emergency unemployment benefits expired and the boost from other stimulus programs faded. Disposable income adjusted for inflation fell 1.3%, but remains 1.8% above pre-COVID levels. So again, you're getting that contraction that's continuing as government transfers ebb, as these benefits that have been knocking around really start to go away, again, minimizing those benefits and taking away from that consumption that we saw in really September and October that is really starting to ebb in November. But we're still seeing that collapse. Again, the durable goods we talked about fell 22%. Non-durable goods, flatlining, but services is coming up. So durable goods is coming down as that services will keep rising. Consumer spending is now 3.5% above its pre-COVID level, but more importantly, it's just 0.4% below its pre-COVID trend. So the deviation, again, still remains in terms of where those goods, we expect that to continue to fall as services rise. And that's when you start looking at, well, what are the other pressures on inflation? Well, the current median CPI, when you look at wages and salaries, this is how much of these wages can really be passed through, can we really see get moved into the system given where inflation is? And the answer is it has to be something if you want these jobs filled, if you want people to be able to afford the rising living wage, the living cost. And then that rotation, this is just putting into perspective what that rotation looks like as you have services coming up closer to zero and you get some of the others, a mixture of durable and non-durable goods starting to come down. As you get some of that divergence, we expect services to accelerate and goods to start to slow more faster now that we're into November and then into December. So then when we look at the U.S. Employment Cost Index, this is looking at that index in terms of what it costs. So when you look at just wages and salary, it's going parabolic, and it's the biggest increase going back to 2005. So you get an idea of this is the inflation side. So you need to pay this not only to get people to come back, but to cover living costs. Look at what it costs to live now, what food, all these goods are costing becomes a much bigger problem based on what we've already seen in the system. But home-based signals a 750,000 increase in NSA private jobs. So the idea is that, or the hope is that we're going to get some of this makeup in private payrolls with a fairly strong September based on who has come to work because, again, the jobs are there and they're trying to fill them as fast as possible. But the relationship between wage growth and inflation has weakened since 1990. So because you've been able to outsource. Well, what happens when you can't outsource the same way? So data indicates that there was a strong correlation between wage growth and inflation from 59 to 89. When did we start accelerating our export of inflation? When did technology really start to grab hold? Was it in the late 80s or the 90s? However, the relationship weakened over the last 3 decades as technology and globalization rose to prominence. The data suggests wage inflation is less of a threat to drive broad inflation, but that's assuming supply chains work, and they're not working. And now you have to onshore more. You're starting to see more come back, which is, again, keeping this pressure point that I think needs to be considered when we're looking at historics and how we're starting to see some of that change in the way things currently work. With U.S. real final sales of GDP dollars, real final sales in U.S. contracted slightly in 3Q for the first time since 1Q of 2020 as you chain it to real final sales because, again, that inflation bite, that slowdown that we've been talking about is really sitting there and aggressive. So then when you start looking at the wage Phillips curve, has there been a shift? And you look at where 21 is on the prime earnings population and what that wage looks like, and you get an idea of just how explosive this needs to be and how that's going to be that driver because you can't get it abroad, so you need to make more here or do more here, so you're going to have to pay the going rate to, again, bring those people into the market. So then when we look at where things sit on search activity for intermediate goods in the supply chain surge, consumers still showing concern over supply chain bottlenecks, which again, why they've been so active and have purchased more aggressively and not waited till their normal, the normal periods of November and December for these deals. And companies were more than happy to give some of these sales a bit earlier to, again, attract some of this capacity. And now this is U.S. excess savings as of Q1. And it gives you an idea of just where it was sitting. So the 99 to 100 percentile on income was 39%. So the top 1% had 39% of excess savings. The 80th to 99th percentile had 31%. So when you look at this, 70% of all of this was controlled by the highest percentage. So again, that gives you an idea of how quickly a lot of this money has gone away for the people that really need it at most, which is here when you look at U.S. personal savings rate, weaker personal income in September, consumers dipped into their savings to finance their outlays. U.S. personal savings rate fell 1.7% to 7.5% in September and dipped below the pre-COVID level of 8.3% for the first time in this recovery. Again, as the rate has, income has fallen, rates have fallen, which has become a much bigger pressure point, which is why when we go back through time, going to the 1960s, so when you look, despite decline in government assistance this year, transfer payments still account for 19% of U.S. individuals' income, but will continue to drift lower. But it's still up there from the 1960s, still providing some of that benefit, which again it needs to be considered when looking at what are living wages right now and how is that going to perpetuate some of this inflation. With U.S. personal income coming back to that trend line, and then when you factor in for inflation, it keeps getting worse. But personal spending. So when you look at personal spending, it's above, but real personal spending is right in line. And the real personal spending is where we see some of the bigger issues, some of the bigger problems as that starts to roll over. I think, October is going to be a good month, and then it's going to be November that will see that pressure point, which is something that we've seen here, as although transfer income has normalized, market income has continued to its ascent as wages continue to go up. But again, is it enough to cover inflation? And as we've shown, it is not, especially when you look at personal income excluding transfer receipts chained to 2012, you flatlined. Personal income excluding government transfer payments ticked up in September, but hasn't quite reached pre-pandemic levels. And as inflation goes up, salary increases slow, this pressure is only going to mount, which is why you look at the Langer U.S. Weekly Consumer Comfort Index, people feel less comfortable. Their personal finances, they're more concerned about personal finances as they see the pressure mounting and this inflation as they start to reject some of these price increases, which is when we now look at consumer sentiment index down 1.1% to 71.7 in October. Current conditions down 2.4% points to 77.7, and expectations, again, we're flatlining, but you still see the fear that remains in the system when you're looking at the underlying capacity for spending, which is when we look at the U.S. daily consumer confidence as it has moved back to where it was back in 14 and 15, and it continues to trend lower based on buying conditions for large household durables, lowest ever. Buying conditions for vehicles, lowest ever. Median expectation percent increase in household income in 1 year, superb. But again, inflation ebbs back what that impact will be over time. And that's that. But at the same time, you still have people that are beholden to buying vehicles, and you could extend some leases. But now as you get to the end of the extension, people have to come in and get a new vehicle. October vehicle sales ticked up to 13 million annualized rate, better than this 12.5 medium estimate, and an uptick from 12.2 million in prior months, but still below August levels. So we're starting to find a little bit of traction as some pickups remain, and job seeking and recruiting remain strong. So again, another driver to where we're going to see, again, a positive jobs number as we exit September. So despite solid investment in intellectual property and R&D, business investment only rose 1.8% as supply chain constraints weighed on equipment investment, down 3.2%, while spending on structures remained depressed, down 7.3%. This is going to start to get better, but IP is going to get a little bit worse, and some of the others are going to get a little bit better, and we're going to congregate a bit closer to that zero line as structure spending increases. So you're not going to see the same drag as we saw this past quarter on structures and equipment. That'll start to come up as IP starts to normalize and come down a touch. But household balance sheets, so net worth, disposable income, again, had that roofing effect. Now, this is Q1. Owners' equity in real estate also roofed, but you're starting to see some of that, the disposable income come down while net worth goes up with equities back at a new all-time high as home prices continue to be at all-time highs. Here's where you see some of those pressures and what that can mean and how quickly that went away in both the 80s and then again in 06 in terms of just how quickly that can adjust from these elevated levels. And then when you look at the renewal rates, because I think this is a good indicator of kind of where that expectations are, we had a record number of renewals during the early pandemic days, and those levels dropped later in 2020 as mobility picked up. We are back to record high renewals because people that wanted to move already have. People that want to move see no inventory, and people that want to move see increasing rents elsewhere. So you're just saying, well, I'm not going to move. I'm just going to kind of hang out and wait because I see where things are going. I'll wait for some of the inventory to come up and for some of the prices to get better in the real estate world. So now we've gone through that in fairly deep detail. We want to shift to Europe and provide an update of where some of the data in Europe is and what does that mean going forward for their growth, their inflation, as we continue to see a lot of these pressure points heading into the end of Q4.